Hello everybody and welcome to the part 1 of the liquidity section. In this section I'm going to be going all over about liquidity, and I'm going to explain step by step using the parts exactly what liquidity is, how to avoid getting liquidated, and so on and so forth, which we'll see later on in the course. So in today's session we're going to begin with what is liquidity. Now, liquidity is an area at which many orders are placed in the market, usually in the forms of retail technical analysis methods such as support and resistance or trend lines. Liquidity is grabbed by smart money so that they can make certain moves in the market. Liquidity can be seen all over the market. Now, I'm going to break these down step by step, and we're going to be using some diagrams and some examples to go through them. So, first, liquidity is an area in which many orders are placed. So, areas of liquidity are areas where loads of people are looking to enter from, right? And loads of people meaning your retail traders, so traders like me and you, for example. So, and loads of those retail traders are taught to trade in such as support and resistance and trend lines. So there's going to be liquidity around trend lines and support and resistance, right? The retail technical analysis, the usual methods, right? And this liquidity is grabbed by smart money. And we looked over this concept when we were going over order blocks about grabbing liquidity. And I'm going to explain that again, but now from the liquidity side rather than the order block side. And liquidity can be seen all over the market. So if we go onto the charts now, and before we take a look at some examples, if I could just explain this to you guys, right? So if we just begin with a simple support and resistance, first of all, let's explain exactly why loads of people are looking to enter from this area and what exactly is going on. So loads of people, as you guys know, are looking to enter from this area because this is an area of support. So what's going on is loads of people are buying at this point, at these points. So if I just bring out my highlighter, so at this point loads of people are looking to enter, at this point loads of people are looking to enter, and at this point, and now at this point, right? And then for sells, loads of people are looking to sell at this point, sell at this point, and sell at this point. So these areas can be called areas of liquidity. So for example, here and here, those are both areas of liquidity, right? And the reason why smart money is interested with these areas is that if they are looking to open a, let's say right now prices at this point, right? Let's say they are looking to enter a 90 million buy, for example. At this point, 90% of traders are looking to buy. So if I just note this here, 90% of traders are looking to buy, right? At this very point in time. And smart money also wants to buy, and they want to open a massive buy position, right? So at this moment in time, they cannot buy 90 million pounds worth of this asset because there are not enough sellers. Because in any market, there needs to be enough buyers and enough sellers. Remember, we went over this in the order block section. So what needs to happen? Smart money needs to grab all of the liquidity at this point. So what they can do is they can sell this market, and by doing so, they have now changed the bias of the market, right? And from this point, they can do whatever they want, right? They've grabbed the liquidity of the market, so they have changed this bias. It can now be 70% selling and 30% buying. So with this new market bias, they are no longer restricted to just selling. Now they can buy, and this would be the creation of an order block, or instead they can just continue to sell. What's important is that this specific area is called the grab of liquidity. Liquidity at this point has been grabbed because all of the traders that were trading this support and looking to buy, they have been stopped out because smart money has decided to sell from this point, right? And so all these traders have been hitting stop loss, right? So we can say their liquidity has been grabbed, right? So that little phrase there, the liquidity has been grabbed, or the liquidity has been grabbed. And so that is essentially what liquidity is, and liquidity grabs, right? So now if we just reset this chart. So now let's go over liquidity in real life market examples. So if I just play price to here, and the most common form of liquidity is, as you've guessed probably, is support and resistance. you will see support and resistance everywhere, right? Even if I just mark up a random place on this chart, that is support and resistance right there, right? Even if I literally just take my trendline tool and place it anywhere, there is support and resistance right here. Price has, look, so if I, let's say here, right, we've seen one touch of this support line, another touch of this support line, again here, touch of the support line. So there is literally support and resistance everywhere. The most important thing is understanding why exactly certain things happen around support and resistance. So around the support and resistance, we've had this area of support and this area of resistance, right? These two respective areas of support and resistance. So what we're looking for is now is we know this is going to be this this liquidity, so we can mark these areas as areas of liquidity, is eventually going to be grabbed. And you often see me putting a dollar sign here because there is liquidity around this area, right? Or you might see people using an X, showing that there are stops and stop losses here and limits and so on and so forth, right? So what do we expect to happen? We expect price to either take liquidity to the downside or to the upside. And simply what I mean by that is price will just, grab liquidity as we went through in the diagram. So if I just play the price, there we go. We've grabbed the liquidity to the upside to, to make a movement to the upside, right? If smart money is looking to buy loads of this asset at this point, they cannot do that, right? And so what they're going to do is they're going to short the market, change the bias of the market, and then they can open their buys, right? And this even is represented by these huge candles, right? And then of course this order block will be mitigated, right? And then we're going to see another movement. So let's just continue playing, right? So now we'll grab the liquidity to the upside. So again, the same thing. Remember, they cannot sell loads at this point, so they're going to buy through this point, and then they can do whatever they want with the market at this point, right? And there we go, a creation of an order block within this area. So essentially this buy order block that we once had was mitigated, right? If I go into a lower time frame, this would have been mitigated, right? Or it could have been mitigated here. And then we had the creation of a sell order block within this zone, right? So now if we go on to the higher time frame, we'll try and mark up that order block. Just go on to the 1 hour time frame. So within this area, because there's a wick here, I'm on a different broker to what I'm usually on. It's probably going to show on a higher time frame because, yeah. So within this area, there is a sell order block that we could have entered from, right? After that grab of liquidity that we just saw. So that is the concept of, liquidity and grabbing liquidity, right? And it's usually followed by an order block. It doesn't always have to be followed by an order block. Like I said, if liquidity is grabbed to the downside, price can just continue to drop, right? From that very moment. And yeah, so that's, that is liquidity, and that's how it's been used in that point. Now, let me quickly just reload this page. Now, just another example of liquidity could be this area over here. So let me just go on to a lower time frame. Again, support, resistance, right? And again, there's this dollar sign here for a reason. Loads of people are looking to sell from this point. Loads of people are looking to buy from this point. And what do we know is below this area? Loads of stop losses are below this area, right? And again, over here. So what do we expect to happen? Price is going to grab these areas of liquidity, grab it to the downside, and now we expect it to grab it to the upside, right? So you could have used that as confidence, for example. Now let's grab it to the upside. Now, what do we expect to happen? Price is usually going to plummet, although it can continue to go up, right? Let's go on to a higher time frame. And there we go, right? And then what do we have? We have another order block here, right? So the main thing is, right, loads of liquidity is being grabbed at the very moment. I can guarantee you liquidity is being grabbed here, and so on and so forth. And the reason these things are happening is because price wants to move into a certain direction for a certain reason. For example, over here, liquidity was grabbed in order for price to go to the downside. Why? In order to mitigate an order block over here and over here, right? Why was liquidity grabbed over here? To fill out an imbalance, right? And if you're not familiar what filling out an imbalance is, we're going to go over it later on in the course, but it's just important that we know liquidity is always being grabbed for specific reasons, and we need to understand why it's being grabbed and where it's going to move, because that will help us, make some money and open some trades, right? So over here, liquidity was being grabbed, like I said, to mitigate an order block within this area, and over here, liquidity was being grabbed to the downside in order to mitigate a zone, an imbalance within this area, right? So that is just an insight to liquidity. Hope you guys found it educational. I'll see you guys in the next one.